Do you think there's still room to run for the FAANG stocks?
Yeah, you're right, Matt. It's all down to the composition of the US market, which is now over 40% in tech, quite incredible. And now we've got, obviously, Tesla's joined the party. Look, on the one hand, it's sustainable because rates are low. If there's one factor that, if you like, works for stocks, it's focusing on the discount rate. So the fact that we have ultra low discount rates means that these growth stocks, they can be more expensive. However, they can be, but now I have to say it's looking really, really stretched. And that's why we'd have much more of a bias towards cyclical stocks now. We still maintain, of course, some positions in these types of stocks. But I mean, Tesla on 300 times earnings. Even Apple's on 33 times earnings. I remember just 5-6 years ago, it was on 10 times earnings, and you could buy it at nearly a 3% dividend yield. Essentially, these growth stocks have priced in this very low discount rate. Fine, that's what we expected. But now it's time for a pause because these ratings are really, really extreme.
Are you worried, Alan, about inflation at all in the U.S.? I mean, we've been talking to people who point out those industries involved with delivering internet goods have seen scarcities, for example, shipping and logistics, and those prices are going higher. I also talked to a couple of investors yesterday who think we could see the 10-year yield at the end of 2021 1.5% approaching 2%. What do you think about that?
So, Matt, I would say, let's say we get some inflation. What would the Fed do? Nothing. What would the MPC, the Bank of England, do? Nothing. What would and there's evidence for that. We saw inflation in 2011. What did the Fed, the MPC do then? Nothing. So even if we get inflation, which, by the way, I think is a long shot. Yeah, I see this graph of break-evens. But look, it's just gone back to normal levels. It was dislocated back in March, like a lot of asset classes. But if you do a longer-term chart, if you pull it up on your Bloomberg and do GPW or GP monthly on that break-even chart to see a longer-term chart, you'll see around 2% is kind of the normal level for break-evens. So there's little evidence for higher inflation globally. We see low inflation everywhere, even in China right now. However, we have had, if you like, magic money in the States, incredibly, and we've got more magic money to come, i.e. money just plonked in people's bank accounts. And therefore, you know, could there be a bit of inflation? Sure. But more importantly for me, especially with the new Fed policy, which is basically average inflation over a long term, they're going to do nothing, absolutely nothing about it. Could bond yields go higher? I doubt it. Bonds are not exactly wonderful investments, but I doubt it with all this QE. And by the way, that's been one of the worst, as it's December 31, as you'll know, Matt, one of the worst forecasts is, oh, next year bond yields are going to rise. They just haven't.